Welcome everyone to another episode of the Gold Silver Bitcoin Show, brought to you by the GoldSilverBitcoin.com store. We are more than honored to be sitting down today with Gareth Soloway. He's a head trader, 20 plus year veteran, a technical analysis master, and he also works in the crypto markets. We'll speak today a little bit about Bitcoin. You can see his trades at verifiedinvestingcrypto.com and his day and swing trading stocks at inthemoneystocks.com. Thank you so much, Gareth, for joining us today.
Hey, thank you so much, and great to be back.
Pleasure's all mine. Last time we spoke, there had not been this cataclysmic event that is the Ukraine invasion the Russian invasion of Ukraine, the Ukraine war, as it's come to be called. And this obviously spooked markets. So for instance, now, although it's normalizing since the invasion 1 month ago, we did see these sanctions against Russia. Now, different analysts think these will have different effects in the West, while some say that Russia is by no means an economic superpower, albeit a military one, that the impact in the West will be low. And then also, we've also kind of heard the opinion that this will have inflationary impacts. So I think that I've heard, I think that the argument that this will have an inflationary impact, the sanctions against Russia, is sound. And we have seen also I like to watch Vladimir Putin's speeches. There's been about 3 that cover about, I believe, 2 hours of discussion. Of course, view it skeptically, absolutely. Now, he has stated, obviously, that he's instructing essentially the private sector to start looking for new suppliers and new partners in markets. And he obviously pointed towards Asia. I think perhaps also particularly the Southeast Asia. Asia in general. So that's cataclysmic. We've had a discussion by countries like, I think, the UAE, questioning whether they would need to buy dollars before, or will continue buying dollars before buying oil. And I believe Russia is demanding that Western countries pay for their resources and commodities with rubles. So lots changed. Gareth, what is on your radar first and foremost?
Yeah, so just going back to the comment about Russia demanding that they get paid in rubles. So number one, we know that the ruble has collapsed. So the reason why Russia is demanding that is because it forces foreign governments to buy rubles, which then pushes the price of the ruble up. So there's a method to that madness. It's not, it's really to help support the ruble because the ruble has collapsed. In regards to what's going on there, I mean, it's a horrendous situation, a sad situation, but it does show us that the economic pressure from the rest of the world. And that's, I think, the big thing about it, is that so much of the world has united. Now, in terms of finding partners in other parts of the world to kind of supply Russia, yes, there's a chance that that China may help, that other countries like that may help. But at the same time, those countries, that they have much bigger trade with the European Union and the United States. And the United States and the European Union have made it very clear. So there's really an isolation going on here, in hopes that the pain inflicted economically can eventually deter Russia from continuing this. Now, again, I think for us as Americans here, the biggest impact for us is on prices, right? So you have Russia and Ukraine huge in wheat exports, oil, we know that, lots of the supply chain, and that's creating upward pressure. We know the price of oil spiked as high as 130. It's currently around 112, I believe. But there's certainly inflationary pressures, which, by the way, just makes it harder for the Fed to do what they need to do. Because, again, the Fed can't, my biggest fear here is that the Fed is in a box, meaning that higher prices are going to hurt the consumer. The stock market isn't making new all-time highs every week like it was last year or the year before that. And it's creating a scenario where the consumer is going to feel the pain and therefore stop buying stuff. And when the consumer stops buying stuff, that's where recession comes in. And then what does the Fed do? If we get in a recession, can they go print another $5 trillion or $10 trillion? And the answer, with 10% inflation, probably not.
We're seeing announcements by Western leaders in both Canada and the US that they are considering stimulus or putting money in the hands of their citizens. I mean, but at the same time, Fed officials are saying that they are implying that there will be big rate hikes even to fight inflation. Oh, a couple things. So I think debit cards for gas given out by California seems like an inflationary policy. And I mean, you mentioned that Fed can't do what they need to do.
Yeah.
Can you elaborate on that a little bit?
Yeah. So, I mean, if you go back for the last 20 years, right, or even go back to like 99, 2000, which is the dot-com bubble that finally burst in 2000, there was this ability for the Fed to just print us out of every recession. So if things got tough, if the economy started to slow, they could print money because inflation was 2% or lower. Right. So that was their go-to plan. You saw it in after 2000 when the dot-com bubble burst. You saw it in 2008, 2009, and then you saw it with COVID. Right. So all these kind of things occurring. Now, the big issue for me is that with 10% inflation, you can't just print money anymore because it's only going to add to the problem. So you're right. They're talking about a 50 basis point hike, maybe for the next two meetings now. My fear is that that's going to cause the economy to come to a screeching halt and push us into recession. But then how do they get us out of that, right? I mean, yes, they could bring interest rates back down, but can they print money anymore? They really can't. So again, this is a new phase that we're in terms of the last 20 plus years, really going back to the 70s. And in the 70s, interest rates got as high as 20%. I mean, if we put interest rates at 20% right now to curb inflation, we would be in a depression.
And that would be a deflationary depression, correct?
Yeah. So, I mean, I think if you put interest rates that high, it would create a massive slowdown and a massive kind of, everyone, basically, even me. I mean, I make a lot of money trading. And if you're going to tell me I could get 20% on my money, I'd probably consider just parking it somewhere and just going to the beach every day, right? So there's an incentive to park money and not utilize it for investments or to grow capital and so forth.
Do you look at? Do you spend time in the Forex markets?
Yeah, so I do a little in the Forex market, absolutely. And is there a specific chart you're thinking about?
What are you looking at in terms of Forex?
Yeah, I think the dollar is definitely of interest. I mean, for me, that's kind of where I'm focusing in on here. Let me take a look at the DXY and I can show my chart. And the dollar has stayed relatively strong, which makes sense because of the problems going on with Russia, right? When there's uncertainty, people run for the dollar because it's always been a staple of safety. Now, in the near term, I think that's going to continue. So as long as you have this kind of fear factor out there about Russia, about China, maybe people will buy dollars for safety. However, longer term, that's not going to hold up. One of the things I'm seeing is you actually do have a bullish consolidation pattern here. So there might be some more upside on the dollar. I see a maybe move to just shy of 101. And then if it gets through that, you could be looking at 103. But again, we're getting a little extended here short term. The underbelly trend line right here would be something I would watch very carefully. If this line ever gets broken to the downside, that's where I would start to get very nervous about the dollar in the midterm.
What we've seen with the dollar so far, there's not a lot of, I think, confidence overall in the European Union, generally in the euro. And so I guess, see a little bit of support in the US dollar as these events unfold. Correct?
Yeah, correct. And again, it's when you have every major economy printing money like the Federal Reserve has, it kind of just keeps everything on an even keel, right? So, I mean, that's the main problem, and why you're probably not seeing more weakness in the dollar is because relative to the yen or relative to the euro, all these other countries are doing the same thing that the Federal Reserve Bank here is. So I think that's why you don't see that. But again, long term, I think it's unsustainable. Eventually, Bitcoin takes over. It might take years, and I think it will take years, but eventually there's going to be some sort of new order of currency that emerges as the staple and really probably the reserve currency of the world.
Something Putin said in his speech was that the world could see commodity shortages, and in that was included gold. He also alluded that demand for gold and other kind of commodities or resources would increase. Can you speak to increasing demand for, and maybe the charts bear this out, but perhaps not yet, for things that we need rather than what we want? So for instance, we're looking at demand in food and commodities and resources like oil and gold. And I think also Bitcoin, as you mentioned.
Yeah, so I think in regards to commodities that we need, food and maybe nickel or aluminum, you're absolutely seeing, and you've seen major spikes. And Putin knows what he's doing, right? I mean, he's not a dumb guy; he's a smart guy, even though we don't necessarily agree with what he's doing. But the bottom line is, there's not a lot of ways that he can fight back against the rest of the world that are imposing these crippling sanctions on his country. So how is he able to fight back? Well, he can talk this tough game on commodities, freak people out. It creates a price spike. I mean, the spike in nickel prices alone that we saw recently was absolutely insane. I mean, absolutely insane. Just to show the chart here, folks, and again, it has come down since this point. But I mean, you basically had nickel going from a kind of a sideways chop at around 24,000. It goes all the way up to over 60,000 in a matter of days, right? I mean, absolutely epic type moves. So this is his way of kind of saying, okay, well, you guys are going to do this to me. Well, I'm going to make it hard on you guys. I'm going to affect your inflation. I'm going to make it tough on your citizens.
How tough are you anticipating it getting for people in the West?
Say that again. I'm sorry.
How tough are you anticipating it getting for people in the West? Have we seen the brunt? Has the market absorbed what's going on? Is Ukraine kind of fading to the background, or could this escalate?
Yeah, so I do think that the markets have gotten used to, the war, which is, it's sad to say no one should ever get used to war, but markets generally adapt very, very quickly. And in fact, we've seen a very substantial rally in the equity markets. If I show my chart here of the S&P 500, this was a massive rally that we've seen recently from the lows. In fact, I think the NASDAQ, the QQQ, is off the lows by as much as 12+% at this point. So from this low just 7 trading days ago, we're up about 12%. Now, I don't think that's going to last personally, because I think, again, everything I'm seeing in terms of the yield. So, and again, this is interesting. Let me just point this out. The 10-year yield used to have an inverse correlation with the stock market. It now is correlated, meaning that if you go back 3 or 4 months, anytime yields would fall, stocks would go up. Now it's the opposite. When yields go up, stocks go up. And today's just another example of that. If I bring up my 10-year yield chart, we're up today. So yesterday was a down day in the equity markets, yields fell. Today is an up day in the yield, and we are up. The reason why this is happening is because the markets are starting to get spooked, where they think that falling yields means a slowing economy and potential recession, versus rising yields may signal strength in the economy. And basically, if you're looking at stocks, you need a strong economy to generate good earnings growth, or any earnings growth at all. So one of the things I'm seeing here, folks, which is why I think the markets are going to head back down, if we go to the weekly chart and we go all the way back to the 80s, there's a trend line here on the 10-year yield, and we're now bubbling up against it, basically 2.4 to 2.5%. If you extrapolate this out and you say, okay, well, yields are going to pull back off this trend line, which is what has happened for the last 30 plus years now at this point, then what that tells us is if the markets are correlated with yields and yields pull back, then the stock market should fall. So that's something I'm watching really closely, and I'm actually been adding to some short positions here over the last couple of days.
And that chart dates us back to approximately the SNL crisis. Is there a reason for that?
Yes.
Saving and loan crisis, 30 years. Can you speak to that?
Yeah, in fact, the trend line, interestingly enough, does go back to basically 1987, which, if you remember, that was the stock market crash, the big crash of 87. So again, I think that's amazing to see that that's when it started. And you almost wonder if it's kind of a precursor, right? I would just warrant one little thing. Like, look at this. The last time we hit this trend line was October of 2018. What happened in November and December 2018? The Fed started raising rates aggressively, and the markets dropped 20%. And look at what yields did, right? So again, there's a correlation between this chart and what the stocks should do. And we are, again, you can see we still have a little bit of room here. So there could be a little bit more upside on the 10-year yield, but we are very close to a reversal in the stock market and in yields here.
We've seen some reversals over the last 10 years, approximately, as we've seen what has been termed the largest bull market in history. Now, are we talking about a pullback, or are we talking about like something more along the lines of what we saw in 2007, 2008?
Yeah, I'm in the camp where it's going to be bigger than just a pullback, right? The old adage is don't fight the Fed. Everyone would say that nonstop when we were going up from basically 2009 all the way to recently, because the Fed, except for 2018 for like 2 months, has basically been lenient and just printing money. But now the Fed has changed. Now the Fed is trying to fight inflation, and they've already raised rates of 25 basis points. Now they're talking about, multiple more raises, maybe even 50 basis point hikes. And so the idea of don't fight the Fed actually is now applying to the downside. So again, what we can see here is this is the long-term trend on the market where we were kind of going up since basically 2009 or so. I can even extend this line out even further here back to that area. And what we did was, here was COVID. And this is where the stimulus just went on steroids, right? So you just had this vertical move because even more stimulus was thrown at the markets during COVID. And now all of a sudden, the Fed is putting on the brakes, taking all of that away. And notice we've broken down outside of that trend. So for me, what I'm looking at is the potential to retrace inside of this range here in basically the next 6 months. I think we go down here. So before year end, I think we're back inside of this area. Again, I don't know exactly where. Is it the high end? Is it the mid end or the low end? But a good basis for me is going by the high from pre-COVID. So if you look at the high pre-COVID, it's almost right in the center there. Now, if you look at where we currently are at 448 on the spiders, and you're talking about maybe going down to 350, that's $100 drop, almost a 25% drop in the stock market from current levels. From the highs, we're already, I think, down about 7%. So we'd be in the range of about 30+% on the downside in the next potential 6 months. And I do think that is a likely scenario here. So it is pretty scary what we're coming into, but the market has to take its medicine, right? We just can't go up nonstop forever.
Elon Musk said something similar. I think he said that it would be this quarter when there would be a pullback, or rather not a pullback, but I guess a crash in the market. Now, your timeline approximates Musk's. Gold, we've seen spike to above $2,000 for, I believe, the first time in history, for $2,000 plus $2,000 USD. 1920 was the old high, I believe, which was achieved in 2012, right after silver. Interestingly, silver beat gold to its top, ran to $49. Now, what do you anticipate from gold as we head into this theoretical market crash? And then what can we expect of gold and silver during it? I mean, let me just comment on silver real quick. Now, silver is still trading, last I checked, approximately $25. I'm not sure exactly where it is today. Now, in March 2020, as you highlighted, it dropped down to $12 approximately. Getting it at the retail level for $12, though, I believe was quite an ask. It was virtually impossible. Yeah. And even as it climbed back up to, I think we talked about this last time, maybe the high teens and 20s, it was difficult to get a lot of these bullion pieces for under $30 even. So just to restate the question, what can we expect from gold and silver in particular as the year plays out and this market crash potentially comes to fruition?
Yeah, so I'm in the camp that inflation isn't going away. I think it is going to pull back. So again, we're not going to stay at 10% or 12% or wherever we top out, because the supply chain is part of that issue, right? So as the supply chain kind of opens up at some point in the future, inflation will come down. But I don't think it's going back to 2%. I think that's a fairy tale at this point. So you have to expect, my guess is 5%-ish inflation for the next maybe 5 or 10 years. I mean, it could be a long, long time, maybe even a little bit more than that in terms of numbers. But the key here is that gold and silver are going to be amazing assets to own. I'm a big fan of gold. I've talked about gold being the best performer of 2022, but talked about that back in December. And you've already seen gold break out of its short-term consolidation pattern. So again, if we look at this chart here, this was a trend line that I had. This was bullish consolidation on gold. We broke out recently. We popped, kind of retesting that 2020 high and pulled back. I do think this is just a pullback of consolidation before we rip higher. I'm basically aligning this with the 1970s. And if you look at the 1970s, we had the same sort of chart pattern, almost identical to what we're seeing now. And by that, I mean, basically, you had from 2018 to 2020 straight up. All right, so that was 2 years up, then 2 years approximately of consolidation before the recent breakout, and now we're starting to break out. If we flip over and go to the 1970s in gold, and let me do that real quick here and go all the way back here. Crazy, amazing how far these charts can go back. And bear with me as we're almost there here. There we go. All right, so here we are on the gold chart, right? And what we can see, and let me zoom out a little bit, is that the same thing played out. It was 2 years up, 2 years of consolidation, and then the breakout started, and it just continued and it continued and it continued and it continued. So for me, buy pullbacks in gold. Again, if inflation is going to be not transitory, which we all know it's not going to be at this point, and it's likely going to last longer, and the Fed really is going to have only their printing ability to kind of combat inflation, or I should say to combat recessions, which are going to come, then the printing is going to continue. Inflation is not going anywhere, and we're going to see a lot more upside in gold and silver.
I spoke with Tavi Costa of Prescient Capital recently, and he's quoted on our show as saying, "Now we've had moments in history with extreme leverage. We've had moments in history with extreme inflationary forces and even speculative environments. But I assert that we'd never seen these three macro imbalances occurring all at once." What's your reaction?
Yeah, so I think that for the most part, you're seeing this. I mean, so name those three again. Let me just hear them again because I want to formulate my thoughts real closely here.
Tavi Costa of Prescient Capital said, "Now we've had moments in history with extreme leverage. We've had moments in history with extreme inflationary forces and even speculative environments. But I assert that we've never seen these three macro imbalances occurring all at once." Now, he cites, I think, for instance, the Depression, the 70s, and also, I believe around 1910 was a financial crisis that he also highlighted as checking off these three events happening separately. That is extreme leverage, extreme inflation, and speculative environments. But he's asserting that we've never seen these three macro imbalances occurring all at once like we are today.
Yeah, so that's it, and it's a good point, right? So you definitely, number one, speculation goes with use of margin and kind of leverage. So we know those two go together, and then inflation is kind of the one that sometimes hasn't been an issue. And if you go back to like 99, 2000, the dot-coms, you didn't really have inflation at that point. Obviously, in 2007 and going into 2008 and 9, you didn't have it as well. Going into 29, the crash of 29 and the depression, that's basically the same. So I agree that the inflationary side of things has not been in existence really for maybe ever in this country, at least since we've been tracking it. And I think that's important because, again, what does inflation do? Well, how do we get out of recession? So let's just say that what we're seeing does come crashing down. And the answer is, well, the government usually spends us out, right? I mean, if you look at wars like World War II, after World War II, all these different things, the government came out with these new deals, these different things to spend us out of recessions. Well, again, how do you do that when you have this 10% inflation going on? That's the question. And I do agree that we have seen the biggest speculative bubble in history at this point in the markets, in crypto. It's one of the reasons why, as much as I love Bitcoin long term, I think it's going a lot lower before it turns around and goes much higher.
Let's talk about Bitcoin. You did on this show in December 2020 or 2021 state that gold would outperform Bitcoin in 2022. That case has only become clearer in the last 3 months, almost 4 months, or no, about 3 months. And I think that increasingly I'm seeing people point this out. You were on top of that. Now, can you speak more to Bitcoin going much lower before it goes higher, what that might look like, and then also Bitcoin in the context of global conflict?
Yeah. So here's the Bitcoin chart. And again, the one of the things, or many of the things that have pointed to my calls about Bitcoin coming down, and then really what we're forming right now is a classic bear flag, which we can talk about in a minute. Let me get rid of these trend lines here. But basically what's going on here is that you still have too much leverage in the system. And I'm a big believer that as much as I believe in cryptocurrency and the blockchain, in what it kind of will become in the future, the same thing was being said about the dot-coms, right? I mean, again, I grew up in the dot-com era. That was when I first started investing. And, everyone was like, oh, the internet's going to change the way we live. The internet is going to revolutionize things. I mean, this is huge. This is the way of the future, the wave of the future. And they were all right, but it doesn't stop bubbles. In fact, it perpetuates bubbles to be formed because everyone chases them. And then eventually fear takes over and the collapse occurred. So you saw stocks like pets.com go bust, essentially. You saw Books A Million. I mean, there were so many crappy companies out there that just got annihilated. And then you look at crypto today, and the same things are being said about cryptocurrency. You have the same pattern forming on Bitcoin, by the way. This M pattern here, and let me show you guys this. This M pattern right here is the same pattern that Amazon had back in 2000 before the dot-com bubble burst. So, I mean, there's so many similarities in the crypto markets that ultimately, and think about this, by the way, now there are over 15,000 cryptocurrencies out there. A lot of them, who knows what they do? They're either meme coins or they're either, I mean, you need a washout, and a washout is healthy. Anyone who's a real fan of crypto wants this. And I know it's not popular because it doesn't make people money instantly and everyone wants to be paid instantly. But when you wash out the junk, the strongest, it's very Darwinian, the strongest will survive and thrive. And that's my belief, is why we have to go lower. You have to see this flush out. You have to get rid of the crap out there. I want to see only 100 cryptocurrencies survive, honestly, and then those can thrive and have real use cases in our economy. In terms of the chart on Bitcoin here, this is a classic bearish consolidation pattern. It ultimately likely leads to Bitcoin at around 20 or sub 20,000. I'm not sure where it'll bottom out, but I do think when it gets sub 20 or around 20, you'll see a lot of the other coins going kind of bust. And that's what we have to see.
I suppose that this will reach its extreme in the event of the market crash that you've hypothesized. We saw in March 2020 that Bitcoin fell to $3,000 from like $13,000. That's pretty extreme. And you say sub 20. I mean, with the way Bitcoin kind of moves at either end of its movements, whether on the upside or the downside, do you think we could see 13,000 again?
3,000 or 13,000?
13 or
13?
and 3.
Yeah. So I do. If we look at the chart, all I can do is basically look at history, right? And the previous winters for crypto have seen about an 80 to 85% decline in Bitcoin, right? So if you map that out, it takes us to kind of that 13 or sub 13,000, right around 10,000, in fact. And then there's a lot of people that are now talking about the potential to see a kind of a correction. And I don't know why my line is that big. Let me get rid of that. But this would be your first target. So the 2017 high, which, by the way, you've never had a cycle where Bitcoin has retested that previous high. Now, the problem with that is that Bitcoin has never corrected in a winter less than 80%. I mean, if you go to 2013, 80+%, 2017, 80+%. So one of these is going to be incorrect, right? We're either going to go below the 2017 high and do 80% or an 85%, or we're not, and then it won't be a true winter. But I'm in the camp that we go down, we see major support at the 20,000 level, but then ultimately we probably go lower. One of the things to just keep in mind about Bitcoin here is that if you map it out with what Amazon did, and the reason some of you guys may be saying, well, why the heck is he comparing Amazon to Bitcoin? And the answer is, if you look back, I think Amazon was the Bitcoin of its generation with the dot-coms, right? It was the biggest company. It's a $1 trillion company. It's kind of where we want to see Bitcoin down the line in 20, 25 years, which was, again, 20, 22, 23 years ago when the dot-com bubble burst. So I think that's the key. But Amazon went from $112 to $6. If that occurs, if that same percentage drop occurs with Bitcoin, you're going back to $3,000 or $4,000. So again, this is kind of a worst case scenario for Bitcoin, but I do think that as an investor, we have to be aware of it. And we don't want to be fear mongers, right? I'm not trying to be fear mongers. Hopefully I'm wrong. Hopefully it never even goes to 20,000. But again, there are way too many issues in the crypto market. The NFTs are a bubble at this point. I mean, there's just so many out there that have to be washed out before the crypto market can get healthy again.
As investors, or maybe people that are looking to hedge, like, this isn't so much fear mongering as I think just classic risk management. Yeah. I guess when you're thinking about a strategy, one ought to think in context of anything, what options do I have if everything goes wrong? And say, for instance, Bitcoin goes to 3K. You have to keep that in mind as a possibility. And I think that's just kind of a good strategic practice. Any comments?
And I think a lot of investors in crypto, they like to keep their head in the sand where it's like, oh, like even when we were at 65,000 and I was saying, hey guys, I think we're going to have a big drop here. I got the, oh, we'll never see below 60. Then, oh, we'll never see below 50 and then 40. And then, and the bottom line is anything can happen at any time in any market. I mean, God knows we've seen nickel go from 20,000 to 60,000 plus in a matter of days. We've seen oil go from 95 to 130. So anything can happen, right? And I think you're right. You have to diversify. So for instance, gold, you could have been invested 50% in Bitcoin since November and 50% in gold, and your losses would not be that bad because gold has done very well. And then you only have 50% in Bitcoin. So yes, you'd be down because Bitcoin obviously has taken a bigger drop than gold has gone up, but it shows you that diversification can protect you. And I think that's so important to understand. You don't have to be one and done. You don't have to be all in on Bitcoin or all in on crypto. A smart investor who wants to build real wealth and avoid cataclysmic collapse, you need to diversify your portfolio. So I hope people learn. I know there's a lot of new investors in crypto over the last couple of years, but you have to understand that the markets do things that even I don't realize. Like I've called low pivots, and then in a short amount of time, we go way lower. And then, yeah, we bounce back and I'll end up making money, but the stock may go 20% below my initial entry. Luckily, I've learned my lesson to slowly inch into positions and DCA so I don't end up getting crushed. And then I can make money that way. But the markets even blow my mind many times.
I mean, the world's blowing our mind these days. Like, for instance, the cataclysmic events that we've seen that have done what were beforehand unthinkable things in the markets, the March 2020 crash and events, and then now the recent invasion of Ukraine by Russia and the sanctions and the isolation of that country. Now, gold and silver. So particularly silver, what are you looking at silver? Like how low could it go in the event of a market crash? What can people expect from the physical markets also?
Yeah, so the physical markets have actually broken out in the near term, right? So here's your big up move from the lows of 2020, and you basically went vertical on silver. It was remarkable, just such a massive surge. But since then, you've been going sideways, right? Now, the thing that caught my eye was when we broke above this trend line right here, and now we've retraced. But again, as long as you hold above this trend line, that's a bullish case for silver. And I think you have to be looking for potential upside to about the 30 triple top level. So you have a pivot here. And again, maybe we come down a little bit more, but as long as we hold this orange line, then I do think we head up to that $30 level. Now, once we get there, that's major resistance. I don't know how fast it'll break through there. A lot will have to do with how much inflation we see on a yearly basis. Now, if you're looking at the bear case, like what would be the worst case for silver? If silver ever takes out this area here, look at all these pivots along this line. All right, that to me would be something that would get my attention. If it does do that, I think you're going down to just over $18. There's huge support right here. Now, again, the question is, well, what would force silver down there? I honestly don't know. The only thing I would think about is yes, silver is a kind of a safety trade, but it's also a hugely industrial trade. So if all of a sudden, let's just say that the globe, including China and Europe and the US and South America, all these countries go into a big recession and people stop buying electric cars where silver is used in those and different things like that, then that could be the bear case for silver. Again, I don't think it's super likely because I think the other side is the safety trade, which would be a buy the silver. But I think that would be the one bear case for silver. I would be a huge buyer. I mean, again, if you're like me and you think that if we get in a big recession, the Fed will just go back to their playbook of printing money again, then any sort of drop in silver to this level or even here is a buying opportunity for me.
Were silver to behave like that, go down to 18 and then do what it did back here, I guess was that April of 2020 through July, that would put it up, I believe, on a percentage basis, right around the all-time high, if not above it.
Yeah, it might even be above that at that point. Yeah, I mean, if you take this distance from right here to this high, and then you did that same kind of measured move from here up, yeah, I think it would put us probably at around $35. In fact, I'm just doing a rough estimate here from 12 to 18, even $36. So again, that would be something of interest. But I think, again, commodity prices, as long as inflation is high and as long as the Federal Reserve doesn't, and global central banks don't have mean, if anyone can think about a different way for the Fed to stimulate the economy or the government besides printing money or making borrowing money easier, which would be like low interest rates, I think that would be interesting to me. I haven't heard and I haven't thought about any other way for them to do that. And that's why, again, I just go back to the idea that, all right, maybe they get inflation down to 5%, and then they got to go start printing money again because higher interest rates, slow economies.
I would guess if I were sitting on an advisory staff, it would have something to do with deregulation, particularly of commodities like oil. Now, can you speak to what oil's been doing?
Oh, yeah. I mean, oil has just had a remarkable move. I'm actually very bearish on oil, and I'll bring up my chart here in a second. So for me, I'm looking for I am short oil right now, in full and fair disclosure. I am short oil. I was short and accumulating up at these highs. And then when it fell down to the 93, 94 area, I covered my short. And now I've reshorted right around my average price is right around this 112 level. So we're basically flattish, maybe, slightly out of the money here. But the case for oil going down is that right now you have a lot of fear built in because of Russia. However, the higher oil prices go, the slower the demand, basically you're having demand destruction. And I already know people, friends, family who are like, I was going to take that long trip across country, or I was going to go to grandma's house 5 hours away. And it's going to cost me $200, $300 now just in gas. I'm not going to take that trip. So you're already seeing the demand destruction, which means there's less barrels of oil needed. In addition, Russia's just turning around and selling their oil to China anyway. So it's not like you're taking it out of production. And again, if I'm correct that the impact of higher rates and higher oil and higher commodities in general are going to have a slowing effect on the globe, well, then it's going to create a lack of demand for oil as well. So I'm hard pressed to understand how we're going to see oil go any higher than the 130 level. I think the other thing that's super fascinating, take a look at this chart. If you take this high right here from 2008 and you look at where we hit right here and you draw a trend line, then drop a perfectly parallel line down, it coincides perfectly with this area here. And charts are obviously everything I do. I think about the macro things like we just talked about, but on a chart basis, this is exactly what it's telling us as well.
Gareth, I'm curious, what are you seeing in the so-called war stocks, Lockheed Martin, Raytheon, etc.?
War is good for stocks like Lockheed Martin. The chart itself is mediocre. It's not something I would chase. You can see that just since November of last year, it's had this massive move up where it went from basically $325 to a high recently of almost $480. So when I look at a chart like this, I say to myself, okay, well, investors obviously are all in on the idea that this war won't ever end, right? That's why it's had so much buying, because they're going to have to resupply. It's also the idea that these other countries in Europe may start to militarize themselves and kind of upgrade their military. So I think that is a longer term positive. In the short term, though, I do think there's room for it to pull back. So essentially what I'm saying here is I think there's an opportunity here. I wouldn't pay these prices. Instead, I'd start looking at kind of this area where if it pulled back, let's say over the next, month or so to the 400 level, there's major support. And I think on a technical basis, that's where you would start to get interested. But again, the one thing we don't want to do is we don't want to chase stocks, whether it's even Bitcoin, right? Bitcoin at 60, 65,000 wasn't good to chase. These stocks at these levels aren't good to chase. Oil here, for instance, I don't think is good to chase north of 110. So what I would do is just sit patiently, kind of be disciplined. And if it comes into a technical support, then you step up and then you buy.
What happens if this conflagration in Ukraine turns into a World War III type situation? We've seen Germany move to rearm itself. Macron, I believe, called for a European army. What could come of that?
So, I mean, that's the kind of the worst case scenario of everything for sure. Investors do have to factor that in. When you look at your risk curve, it may only be a very small percentage, but you do have to kind of evaluate that as being a risk for your portfolio. So again, having a stock like Lockheed Martin at the right price would protect about that. I also think gold, we talked about gold earlier. That's one way where gold would just go nuts. If you saw that occur, gold would be absolutely off to the races, to the upside. And then I think, again, you kind of just look for contrarian type views. I'm a trader that goes long and short the market. So for instance, right now, I think there's some good opportunities being long some of the global equities, maybe in China, some of these other ones. But I also think that you can look to be short some that are overbought. CLF, that one's had a crazy move. In fact, let me show you guys that chart because I'll give you guys this trade setup that I'm looking at. So if I show my chart here, and bear with me. So here's your chart of CLF. Now CLF has gone up, astronomically, basically, at the end of February, so less than a month, it's gone from $17 to all the way up above 32 here. There's a trend line here that I'm watching where at this point, if this were to hit tomorrow, I will pull the trigger on a short trade. And so again, there's always a level to look for either a long or a short. You just have to be disciplined to kind of abide by it. But look at this long-term trend line, how it kind of touches all these tops. It looks like the chart is going right back to that. So I think the essence or the moral here is that, you have to be prepared. You have to factor in all things. Having some side in cash is probably a good scenario because if things get crushed due to World War III, you would have that ability to buy very cheap. I mean, you would see a panic in the markets, possibly even the markets get shut down for a period of time. So again, there are opportunities, just you got to kind of analyze it accordingly.
Can you speak to maybe gold in the context of a World War III scenario a little bit more?
Yeah, I mean, I think that gold, when life is uncertain, becomes the ultimate safety trade. And I think, if you're talking about World War III, you're not just talking about bombs. You're talking about bombs, but you're also talking about major cyber attacks, grid attacks, basically the worst that we could imagine of every type of scenario that's there. And for me, I have a hard time of factoring in Bitcoin during that because yes, you can take your Bitcoin offline, but let's be honest, most people have it online. And therefore, if the grid went down, your Bitcoin essentially is worthless unless you're able to transfer it when in some other method. So I think gold, something physical that you can hold in your hand, silver, that becomes the ultimate safety trade. All right. And I think that's something that people have to be aware of, which is, by the way, that's one of the reasons why I have physical gold. Now, a lot of people will buy the GLD, a lot of people will buy the GDX to get minor exposure. But really, if things really hit the fan, then the physical is what that you can hold in your hand. If your credit cards don't work, I mean, that's really where you want to have a little bit of physical on hand.
And the percentage-wise between gold and silver, we looked at the charts a little earlier. Is there one that you think just seems like a sure bet? For instance, I would argue that silver seems like it is perhaps where people have the least downside risk in comparison to gold.
Yeah, I mean, it's a tricky one, right? So the way I look at it is which one has the industrial risk. So for me, silver, I'm just slightly more hesitant on because, if we had a World War III, well, if you had a World War III scenario, there might be a big demand for silver because of the industrial side. But if the economy slows, then I do worry that the industrial side of silver would suffer, even though it's a store of safety, which would keep buyers coming in. It's not the pure play of safety trade versus gold. So for me, I would say silver has more upside long term. It generally outperforms gold. But in the short term, if you're expecting over the next 6 to 12 months a economic slowdown, silver may underperform gold just a little bit.
We mentioned also earlier a little bit about the UAE, thinking about perhaps not ditching the petrodollar. Mm-hmm. What threat, I guess, to economic stability does de-dollarization pose? And what is the likelihood of that, in your opinion?
Yeah. So I heard that. We also heard about, maybe trading with Russia trading with China in yuan, digital yuan or something like that. I think that this is the beginning, the very early stages of a move away from the US dollar. So I don't think right now it poses much of an issue, but I look at it like a warning shot. It's something across the bow of the United States saying, listen, there are other countries that want to displace the dollar as the reserve currency of the world. And if you get enough of them, then it will be problematic for the dollar. And I actually do think eventually it will happen. I still think it's years and years away, but there will be a point where some other currency does take over, or maybe it's a cryptocurrency. We're not sure at this point, but certainly something will take over. And that's really where the dollar will collapse. I think the dollar holds generally well until that happens. But once, if you think about the reserves that various countries, China, Japan, European countries, they have to hold massive reserves in dollars because all the trading is done in US dollars. If all of a sudden that's not the case, there's no reason for them to hold that many dollars. If they dump those dollars on the market, it's going to cause the dollar to decline very sharply.
If that happens, do you expect it to be a cataclysmic quick event like we've seen, with a shock in the markets? I guess perhaps Ukraine is not the best example, but March 2020 might be a corollary. Some just massive, like shutting down the global economy is quite a big shock. Now, obviously, do you expect de-dollarization to happen like overnight, for instance, or do you think that it's going to be kind of a more long drawn out process? And I mean at the acute phase too.
Mm-hmm. Yeah, so I expect it to be, it's going to be slow at first, right? So it kind of reminds me of the stock market. You don't go from all-time highs to multi-year lows overnight. What ends up happening is you have a lot of people that still believe in the dollar, some that don't, and that ratio slowly adjusts. So you see the dollar kind of curling over, you see it have a dip, then buyers come in, then a bigger dip, then buyers. And if you remember in 2008, the stock market after the 2007 highs, it kind of rolled over a little bit, then popped back, kind of like what the stock market's doing now. In fact, the big collapse occurred at the end in 2009, right? January through March 2009. That's kind of what I expect for the dollar, where you'll have this initial kind of rollover, then bounce, rollover, then bounce. But at the end, yes, it will be a collapse. It'll, everyone will throw in the towel at one time, and there'll be a mass exodus, and then it'll flush out.
And where will all these assets run to? We talked about gold, silver. Where else do you think people might be sitting in order to, I guess, make it through to the other side in the event of a dollar collapse, de-dollarization, et cetera?
Yeah, so I think the big move would be, right, gold, silver, platinum, and basically commodities in general, right? Because if commodities being traded in US dollars, then obviously those prices would go up. They'd hold their value versus the US dollar. I also think investing in foreign equities, right? So if you have a company in China or South America or Japan who's making a majority of their money in that local currency, so if it's yen, let's say, well, if the dollar declines, then their earnings in terms of dollars are actually going to go up very dramatically. So that would also be a way you can hold your value quite a bit. So there are ways to position. Again, it's not something that I'm thinking we have to do at this time, but I think as a good investor, you have to always be 2 steps ahead of everything, right? You don't have to act on it, but you want to see what could come and then decide how you want to react so you don't get caught off guard, right? The worst thing for an investor is something happens and you're caught with your pants down essentially and like, oh my goodness. So I think that's really important to think 2 steps ahead.
Is that the type of scenario where we get Bitcoin at $1 million, or do you think that is perfectly reasonable for Bitcoin to achieve $1 million price target by virtue of demand and supply and demand?
Yeah, I think it'll be a combo, right? So I think you'll have to have concerns over the dollar, which is kind of why Bitcoin came into existence anyways. I mean, back in 2012, it was created in 2009. I first started to take note in 2012 and kind of say, okay, well, this makes a lot of sense. If the government is running up massive debt, if the Fed is printing money, and they were already printing from 2009 at that point, then we need some sort of digital gold, if you will, to hold that. Now, I think that's part of it. The other thing is if you can just get the right, and I stress right, regulation in place to make more people feel confident, if you can get adoption in Bitcoin. I mean, if you just think about if all the hedge funds in the world picked up just 5% of their amounts in Bitcoin, if pension funds, which have trillions of dollars, just did 5% allocation in Bitcoin, we could be at 1 million even before the ultimate collapse of the US dollar. So it's a combo, but I think, again, the adoption is the most important thing for Bitcoin here. There's so many people that have adopted Bitcoin, but there's still so many more and really big money that needs to.
Ray Dalio had a quote that was floating around the internet regarding just diversification in these uncertain times and how important it is to be diversified to the extent that your portfolio is essentially ready for any eventuality. With that in mind, then, that makes me, as somebody who's attracted to physical commodities and assets, think about things such as platinum, as you mentioned, palladium, even maybe a little rhodium, for instance. When it comes to platinum, can you speak to the kind of virtues of platinum investing as it stands today?
Yeah, so I mean, I think platinum for me is right along the lines of exactly what we're talking about with gold and silver, right? I mean, there is a use case for it, so it has that industrial side a little bit, but at the same time, it's still a metal. It's still something that is somewhat on the scarcer side. So in terms of inflation and the dollar being printed and everything that we're going through, you would generally assume that this would trade higher over the next, 6, 12, 18, 24, even the next few years. So I think, again, really think in terms of inflation not going away, eventually the economy weakening to the point where maybe inflation's back to 5%, but unemployment shoots above 10%. What's the Fed going to do? Well, they're going to say, well, unemployment above 10% is way worse than 5% inflation. So we need to bring that down. How do we bring it down? We stimulate, we print more money, which now pushes inflation up to 7% or 8% or 9%. And you just get this kind of back and forth with the Fed. And I think we talked about it earlier, but I hope there's something that the Fed can think of to do that I'm not thinking of. But aside from stimulation through low interest rates and printing of money, I don't know what other tools the Fed has at this point.
I spoke with John Tamney of FreedomWorks recently, and he was advocating for essentially like a gold standard, return to the gold standard. I think if we look at historical gold standards, that doesn't mean that there's an ounce of gold for every dollar in circulation or 100% backing. There is generally, I think historically, approximately like 40% backing of gold-based currencies. Do you think that would be a viable solution, or might that kind of bring on a deflationary spiral?
That's a good question. I don't think, I'm not sure if it'll bring on a deflationary spiral, but I don't think that the government would ever go that route. I think the government has enjoyed the ability to kind of print when they want to, not necessarily having to have reserves or anything like that. So I'd be somewhat shocked if we ever go back to that point. But I do foresee that at some point when the dollar does collapse, and you're going to see the Federal Reserve take a huge amount of that blame, the government will as well. And the people will rise up and say, hey, listen, the government, we need to fix the financial system. And I think from that's where some sort of new cryptocurrency comes into existence that supplants the dollar. Now, I don't think it's going to be Bitcoin. I think Bitcoin is going to be the digital gold for the next 50, 100 years. But I think some sort of new cryptocurrency that is controlled by the government, but there are restrictions, meaning that it can expand at X% per year, but it's stated and the people understand that. And I think you also will see the government being forced into a balanced budget type scenario where you don't allow these ridiculous deficits to continue. So again, it's almost like a little bit of a reset. I still think it's 10 years away at earliest, but it might coincide on a cycle with the 100-year cycle of the Great Depression, where we go through this kind of epic dollar collapse. And from that rises a new financial system that is kind of based on cryptocurrency.
Before we get to that point in time, now we talked about platinum a little bit. What are your thoughts on palladium and rhodium?
Yeah, so let me just take a look if I have the rhodium chart here. I'm not sure if I do, but let's look at palladium. So palladium, and I'll show this chart here. It's been kind of all over the map because of obviously what we've been seeing in Russia. You can see this huge move up here and then a retrace. Now, to me, it looks like it's forming somewhat of a little bit of a bearish pattern short term. So there might be a little bit more downside here, but I think you got to start looking to accumulate around 2,200. So if you dip into this level, maybe around 2,000, somewhere in this vicinity, there's a lot of support on palladium. So again, the same thing with rhodium. Right now, I'm not finding the chart on it, but I think, again, rhodium is one of the rarest things, if not the rarest of the metals out there. And it's a great asset to have if you want to have it. And again, people should definitely look more into that one because that's an interesting one to potentially own.
What is this on the chart, the palladium chart, the wick down, the flash crash?
Yeah, you know what? I'm not 100% sure. I don't follow the palladium chart quite as much as I do for gold and silver, but it looks like it had a big gap down here at the end of December. I don't know if that was related to, something with the futures market or with it was just a print down there. But certainly, I don't know if anyone got in it down there, but that was one heck of a buy if they did.
Yeah, it reminds me of some of these people who every now and then when there's like some sort of glitch on a crypto exchange and they had options at a certain level and they end up like, because the exchange broke down or something, ended up with a real good, nice entry point, like a Bitcoin.
Yeah, for sure.
Great. So Now, any other comments you want to make before we wrap up that people should know about the markets in the context of here we are in March 2022?
Yeah, so I think just realize, and again, the biggest thing we need to remember is that the Fed doesn't control the day-to-day movement, but the Fed does control the markets in the direction. And the Fed since 2009 has been all about printing money. They had sub 2% inflation, so it was okay. Now they have 10% inflation, and now they're saying, hey, listen, we have to pull back on this. So you have to expect the markets to be more volatile and ultimately go lower. Otherwise, every thesis that anyone's made for not fighting the Fed wasn't correct, right? Because again, we were told not to fight the Fed on the way up when they were printing. Well, now if they're not doing that and tightening, then it should be to the downside. Doesn't mean we won't have amazing bounces. We've had amazing bounces in the market, but ultimately look to fade those, start looking at a portfolio that's more nuanced, that's more diversified, just like you were mentioning before. Diversification is a must. You have to diversify in this environment. This isn't the environment where you just go long one stock and hope it's a meme stock and make millions of dollars. You need to be prepared for whips and constant movement and just be safe, folks. Again, safety is unbelievably important if you want to build wealth.
Would you consider would you consider silver a safe haven right now that minimizes people's risk? Or are you talking strictly USD?
No, I think silver, absolutely. Yeah. So silver is a great way, not to say that there's no downside in silver, but, for me on the chart, I look at support at 24. It's right now at 25.55. So, I mean, minimal downside risk there. And even if it were going to go down, let's say to the 21 support, there's lots of support here, right? So I'm looking at the US equity markets and I'm saying to myself, I could see 20, 30% downside from here, even in the next 12 months in the equity markets. But again, you look at it and you say to yourself, okay, if we factor in the printing of money, we'll likely resume. If we do get that, then you need to be in these commodities as safe havens. And again, it doesn't mean all in on silver, all in on gold. It's just diversify your portfolio so you have some silver, some gold, probably some stocks as well. And then maybe even some short situations. I'm short oil right now. I love that short on oil right now. A lot of people saying it's going to go to 150 or 200. I just don't see it.
Tell us about your services. Where can people find you? How can they sign up for your services?
Wonderful. Yes. So I have two websites. One's verifiedinvestingcrypto.com. That's strictly cryptocurrency investing and swing trading. I do a daily video each day for the service members with lots of technical analysis. I put out anytime buyers or sells come up. I put those out real time for our members. And then for stocks, it's inthemoneystocks.com. And again, same type of service, but I just do stocks and ETFs there.
We've had the honor and privilege today of sitting down with Gareth Soloway. He's a head trader, 20+ year veteran. He's a technical analysis master. And you can check out his verified crypto trades at verifiedinvestingcrypto.com and his day of swing trading stocks at, as you mentioned, inthemoneystocks.com. Thank you so much, Gareth, for joining us today.
Thank you so much for having me.
And the pleasure's all mine. And thank you everyone for listening.